All right, so last Tuesday we started a new chapter, short-term decisions, and we went over a few of these, of all the 6 decisions that we're covering in this chapter, we went over the first 4, right? So first one here, whether or not, let's just briefly review it before we go to the last outsourcing and process further or sell as is. So the first 4 decisions was on whether or not to accept a special order. Second, how do we price the products for different types of industries? What are the strategies we use? Whether or not we want to drop a department, drop a product, what are the considerations? And the fourth one was how do we mix products? What are the products that we usually emphasize more than others? Okay, so the first 2 was in the second section of the chapter, third and fourth. Third section, and today we'll be introducing 5 and 6, the very last ones, to complete this chapter. So first of all, special order. Remember, the first consideration was whether or not the business has enough capacity to actually accept the order. Remember, I went over a copier business. If you have 3 copy machines, for example, all 3 of them can copy 36,000 pages. So if you have a special order that comes in physically exceeds your capacity here, then the first question here, if your answer is no, then we're not able to actually meet customers' requirement, right? So if it's yes, what would be the next question? Do we actually get a profit out of it, right? So if this consideration, after considering capacity, if this is yes, second question would be whether or not the excessive revenue we're getting out of this special order actually exceeds the total variable cost plus fixed cost to produce this order, right? So sometimes special orders, if it's larger in quantities, perhaps customers will request a discounted price. So you still need to evaluate whether this discounted price actually covers, especially variable cost at least. You have to get a positive contribution margin out of it. So if fixed cost is the same, if your company is still producing within the same relevant range, then fixed cost is the same, and if you already broke even, then that is not really the main consideration there. So main consideration would be variable cost, whether or not the discounted retail price actually covers variable cost. Okay, so these are the 2 main considerations, capacity and whether excessive revenue is higher than excessive cost. Okay, in this part, especially variable cost if fixed cost remains the same. So what about the consideration for pricing? How do we price a product? That depends on whether your business is providing products that are considered more special, unique. Do you have cutting advantage over other companies? So this was an example on the special order. Remember the baseball cards, just to refresh your memory a little bit. So we accepted the order if the excessive revenue covers variable costs, and then we rejected it if we have additional fixed cost. After considering fixed cost together, cost exceeds revenue. So we went over this together. Remember baseball cards. Okay. So this was the first decision making on whether to accept or reject an order. So for pricing decisions, we want to know, of course, we need to decide, first of all, what is the target profit? What is customers' demand pay of these products? But whether or not what type of strategy your company is able to set in place to set the price depends on how unique the product is. So if your products basically is more toward the groceries, the basic necessities of living for each and every one of us, it's more of a price taker. Right? So those companies typically need to know what is the current market demand for the products, what's the competitor's price, so they can't really move too far away from that price. Otherwise, they probably won't be able to get decent sales revenues at all for each and every season. So they don't have that much of a control on setting the price. They're more of a price taker side. So as opposed to that, if you own innovative products, technology-driven products, then those are more on the price setter industries. So you have more control over your price. The approaches you'll be taking will be different. Right? So for price taker, groceries, natural resources, Usually we emphasize a target pricing approach, meaning we're understanding market price minus the profit, and then we try to meet this target cost. So the more we can reduce here, the more profit we're getting in the middle. Usually we don't move at the sales price too far away from competitors' price. A cost-plus approach, pricing is usually used for price setter companies. Again, if your product, as long as you're able to persuade customers that it's more unique, it has some features that your competitors probably were not able to provide to them. So this cost-plus approach, we don't move backwards, but we start from understanding what is the actual manufacturing cost. Then we plus the desired profit. Of course, we still need to know what is customers' demands, what is customers' requested price for the product, but it's more of a reference. We don't actually need to follow exactly whatever the results we get there. Okay, because if they believe this is different from the competitors, different from what they have 5 or 10 years ago, if it's a breakthrough, and usually these companies, the products, they have more control over what range they want to set the price at. Okay, so setting the price, there are 2 different approaches for different types of industries. And then we went over this example. So remember, for this company here, since you know the competitor's price, $3.60 for each plant, the problem tells you that competitors provides exactly the same plant. So this is a hint telling you that this industry actually is more leaning toward the price taker or setter. They're a taker, right? Because if competitors are able to provide exactly the same product, it's just a matter of different suppliers, different vendors, then usually you can't move too far away from $3.60. So to determine the target cost here, we start from understanding the target retail price, move backwards, minus the desired profit to get what is the target cost for this company. Okay, so this is a problem that we did on Tuesday. And then after this question, second question was, what is our current cost? And then compare it against the target cost. Right, so we want to know how well this company is doing, add up the variable cost, add up the fixed cost, to see whether we need to reduce this or not. Okay, so this is just a review of what we did on Tuesday. And then the third question, if we reduce variable costs, are we now able to meet the target cost? Do we have to reduce further our fixed cost? So from this example, we went over at the end, our fixed cost is good because remaining $600,000 is less than the target cost now. We're able to actually meet our desired profit if we reduce variable costs to $1.20. Okay, so this is also linking to the previous chapter on some of the what-if analysis. What if we reduce variable costs? What if we reduce fixed cost? How would this change our desired profit? Are we actually able to meet the profit? Okay, so this is an example for the second decision. How do we set prices, and specifically on price taker industries? How do we decide whether or not to drop a product? What are the main considerations here? Contribution margin, that is the first question. So do we have a positive or a negative contribution margin? So if we have a minus contribution margin, that means we're not even covering variable costs, so we can directly just consider drop the product because we're not covering variable cost, let alone fixed cost, right? So if it's a minus negative contribution margin, just simply drop the product. So of course, companies are not setting the retail price to make their contribution negative at the first place. Sometimes this is because if the product gradually becomes obsolete, the market is not demanding as much, so the retail price keeps on decreasing. So to what point do we need to drop it? To a point when there's negative contribution margin. Okay. Now, if there's still positive contribution margin, then what do we need to consider then? Whether there's avoidable fixed costs or are the whole set of fixed costs unavoidable. Okay, so these are some of the relevant questions. First of all, contribution margin. If that gives you a positive contribution margin, then the second question will be, do we still have all the fixed costs in the case we drop the product? Are there specific tools, machines that are just specifically used for this product? And if we terminate this product, the whole set of costs disappears. If that's the case, that's considered avoidable fixed costs. And it's relevant to this decision because at the end, we want to know how much cost saving we're making if we drop the product, and how does it compare to the revenue that we are giving up. Okay, so if the total cost saving here, variable cost plus the avoidable fixed cost, if total these up, it's a lot more in quantity compared to revenue, then of course the answer will be dropping the product because we can save more. Okay, so this portion of saving is not just variable costs. Sometimes some portion of the fixed costs we may be able to avoid as well. So other times some of the fixed costs, if it relates to multiple types of products, it's used to produce different lines of products, then even though you drop this type of product, you don't produce it anymore, perhaps the machine, you still need to depreciate it. If it's used by straight line, the fixed cost is still there. For some of the employees, the manager is not planning to lay them off, perhaps rearrange their responsibilities, then the cost, the labor salary is still there. Right, so some of the costs here may be avoidable, maybe not. We have to add up the portion that is avoidable. That becomes the cost saving your company is making if you drop the product. And then compare it against what's the sales revenue that we're not getting after dropping the product. So weigh which one is more than the other. Okay, so of course if we give up a type of product, then that department, either the space, the resources, how can we use it better for other types of products? So we also, managers need to consider this as well. If we drop this, are we able to use that machine to produce more of other products that gives you higher contribution margin? So how do we do, what do we use the free space for, free capacity for, and the resources? So overall, the main decision here is add up all the cost savings, compare it against revenue. Which one is higher? Cost saving, if it's more, then we drop the product. If cost saving is still less than the revenue we're getting, we're still getting more, then we keep it. Okay? So the last example, last decision making we went over was product mix. So for product mix, which types of products we want to emphasize more? Is it cat beds? Is it scratching posts? Depends on whether the contribution margin we're getting for every unit of constraint, which one is higher. Okay, so it's not really about unit contribution margin. It's about every machine hour, for example, how many units you're actually able to get out of every machine hour. And then use these units to multiply the contribution margin, which one is higher, which one is lower. Okay, so the last example I went over here was regular DVDs, special DVDs. If every single hour you're only able to get 10 of the discs for the special ones, 100 for the regular ones. If 100 only generates 10 cents each, every hour you're generating $10, right? If the special one, even though you're able to generate 10 discs, you're generating 90 cents for each disc. But overall, you're only getting $9 out of every hour of manufacturing cycle. Okay, so even though the unit contribution margin, some of the products may be higher, but if your company, the machines, the tools you have, physically every single hour you're not able to get more of these higher contribution margin products, then probably it's not a good idea to emphasize this. Okay, but of course the assumption here is that both of the products customer wants. So we now want to decide which one we want to emphasize more. So for this case here, we want to emphasize every machine hours, the total contribution margins, the ones of the products that we're able to get more of. Okay, or for every labor hour, how many delicate products that we're able to get out of it. So some of them, even though the unit contribution margin is higher, if we're not able to produce as many in quantity, then we may need to drop them or less emphasize them. So this is the fourth decision. How do we weigh which products emphasize more than the other. Depends on the unit of cost stream. Because each and every company, they only have limited resources, right? So they can only use certain machines. They only have a certain number of workers. They need to use them to produce the most contribution margin. So this breaks down to the quantity plus how many, what is exactly the contribution margin for every unit. Okay, the quantity is also important. So every hour, how many products you're actually able to produce. Now this last question here was, last exercise we went over, remember which department to drop, which departments to keep. So it's pretty obvious that one of them has a significant negative loss, operating loss here. Negative number, $18,000. But really what we need to focus on here is whether a certain area of fixed costs is avoidable or not. So some of the fixed costs may be unavoidable, some of them are avoidable. If it's avoidable, it means if we drop the department, the cost also disappears. So in this case here, we look at both set of variable cost and fixed costs. If this problem changes to unavoidable, then that means we're only looking at variable costs. We don't have to compare fixed costs, so it's not relevant. Okay, so for this question, it seems simple because this is avoidable, so you need to add up both categories of cost and compare against revenue. Right, so we'll be looking at 92,000 plus 26,000, 118,000 compared against the revenue we're giving up, 100,000, and see which one is higher. So cost saving is more because 118 is larger than 100, right? So in some cases, if this is unavoidable, we'll be comparing 92,000 against 100,000. Then the answer will not be dropping the department. Okay, the answer will be considered further because this is still giving the company positive contribution margin. Okay? So of course the company, since they're having negative operating income, they may want to minimize the variable cost more or try to boost up the sales revenue in larger quantities. Right? But if this is unavoidable fixed cost, then we're just looking at contribution margin. 3 departments, all of them has positive contribution margin. So the answer will not be directly dropping the product. It will be considered further. If it's unavoidable. Because unavoidable, we don't need to compare the fixed cost anymore. Okay? Avoidable means that if you drop accessories, you're saving 118 and you're not getting revenue 100 because all of the costs will disappear. If it's unavoidable, meaning that fixed expenses, for example, could be certain furnitures or assets used in that department, can still be kept on being used in the business, so it's still there. You still need to depreciate it. So that $26,000 will still occur next season, right? So then the cost saving you're really making is just $92,000 compared against $100,000, right? Now for all the remaining departments, men's and women's, it's pretty obvious that they do have positive contribution margin and it's also covering fixed costs. So the problem here is just the third department. And this problem here is avoidable, so the total cost saving is the total set of costs, both variable and fixed costs. If it's unavoidable fixed cost, that means if you drop accessories, the $26,000 will still occur. So you're just comparing 92 against 100,000. Well, 92,000 against 100,000. All right? Okay, so I just wanted to kind of review the concepts that we went over on Tuesday, since the last 2 also relates to the first 4 decision making. The logic is very similar. So next one, whether to outsource or not. Now before I go on to outsourcing, what do you think should be considered by managers? Do you want to produce something in-house, or do you want to directly just buy it elsewhere? What do you need to evaluate? The price that you need to purchase, the cost that you're spending on buying elsewhere, and the price that you're actually using to produce it, right? But it's actually a little bit more than that. That's obviously the first question that they have to consider. What is the price that they're paying to other vendors, suppliers, when they purchase something that is readily made? It's probably not a whole product, probably just a portion of it. Some parts of the that puts together becomes finished products, perhaps not exactly an entire bicycle, probably just a portion of it, the wheels. So how do they decide whether to purchase it or to produce it? Of course, what is the variable cost incurred when we actually produce it, and also fixed cost? But what about purchasing? What's the price that we're paying? Besides this, we also need to consider opportunity cost, meaning that if we don't outsource it, of course we need space, we need machine, we need labor, altogether these manufacturing costs. Now, if we do outsource it, besides paying the money, we may have free space here. We may have freed up machine hours, freed up labor hours. What do we do about them? If we're able to use these free space to generate more products of other kinds, then that profit we're getting there also needs to be considered. Okay, so meaning if earlier we were manufacturing it in-house and now we're taking it out, outsourcing it, we do have a free area. We have some of the free machines that are no longer used for that particular part of the product. So what can we do about the free space? If we're able to generate more of other kinds of products that also can turn into profit, that profit also needs to be considered together with this decision. Okay, so meaning how do we utilize the remaining space if we do outsource it? Those two needs to be combined, considered together, and weighed against manufacturing cost. Okay, so let's take a look at this example with actual numbers. Say we want to produce a type of product, and if we do it in-house, we have variable cost that breaks down to materials, to labor costs. We talked about in the first 3 chapters, variable overhead. Altogether, can you tell me how much variable cost is there if we produce it in-house? We have $75,000 if we produce it in-house. This is the variable cost part. And we have fixed costs, $50,000. So this is producing in-house. What about outsource? Obviously, we don't have any variable cost on producing it. We just have perhaps a portion of fixed cost, meaning after we outsource it, if we want to package it with other products, let's say, and together that whole set becomes the final product for customers' purchase, we perhaps need also some types of machines to combine it together with other products, for example. So $40,000 here, and we need, of course, the purchase costs to purchase the final product from others. Altogether here, from this example, the total cost for outsourcing actually is higher, right? We purchase a part of that product, but we still need to, some portion we still need to manufacture it, still costs us $40,000. So if we stop over here, can you tell me how much is the avoidable cost for fixed costs if we produce it in-house or take it elsewhere? Avoidable is $10,000, but we still have unavoidable costs, which means it's still there regardless of producing it in-house or take it out. We still have $40,000 there. Okay, so the purchase price, the price that we're paying others is $92,500. The price that we are still paying, even though we still outsource. Even though we outsource, we're still using fixed overhead, $40,000. Altogether, this is actually more than producing it in-house. So the decision making here will be still produce it in-house because this is too much. The purchase price that we're using, $92,000, covers the variable cost, but it doesn't cover fixed cost. Okay? Remember that we have something else to consider too. This is just considering the purchase price, $92,500. If we take it out, remember, we still have some free space or other machinery that will be idle. So what if we do something about that portion and decide to actually make some profit out of it? In that case, this will not be $132,500 because if we take it out, we need to also consider any profit that we're getting out of it. So this is considered opportunity cost. Meaning if we choose outsourcing decision Let's say if we don't choose the outsourcing decision, what are we giving up? We're giving up $132,500, which seems great at this point. But what if we can actually get something out of the free space? Then we're also giving up this, for example, $18,000 of profit if we're able to use that idle machine to produce something else. So altogether, the real cost for outsourcing is not just the money that we're paying, not just the fixed cost, but also the profit that we may be able to get from that capacity, the remaining idle capacity. Okay, so this portion here is still in-house costs. This doesn't change. What changes is if we also add in the consideration of how do we use the idle machine. Of course, the managers can still make it just simply idle and leave the space with nothing there. But if they make use of that, if they utilize those machines, the labor hours, they may be able to generate more profit out of it. So you also had to add back the profit. After this, you can see that the numbers changes now. So we're comparing $114,500 against producing it in-house at $125,500. $125,000. Okay, so really there's only two things. One is, what is the purchase cost? What is the money that you're paying to suppliers? So this case here is $92,500, right? Now some cases, for this particular example, they say they do need other manufacturing fixed cost occurred. Sometimes there's none of that. Sometimes this is good enough. But this problem here, we still have fixed overhead occurred, for perhaps package it with other products, and that machine's depreciation cost. Okay, think of that example. So we have two types of cost altogether. Up to now, it seems like the outsourcing cost is this, right? Third step, if we consider outsourcing, then the original manufacturing plan, let's say we had 6 cells that were producing something, now we have 1 cell that we outsourced. So what do we do about this? This physical area, we probably can get something, or whatever the original machinery was, we use it to produce something else, other products. So if this is the case, if the problem tells you this is the case, whatever the profit is, the output of this area is production, basically. Whatever the cost was, but subtracted from the revenue, whatever the profit is, this also needs to be considered together with this outsourcing decision. So in this problem, you assume that you estimate that the projected revenue will be this. Okay, so this is a budgeting decision, of course. Before they make this decision, they have to estimate it. Okay, we'll go over a lot more budgeting decisions in the next chapter. Basically, if they project that the $18,000 is the potential profit, then this will actually reduce the cost of outsourcing, the overall cost. I'm not saying that we're reducing the price we're paying to others. We're still paying this. We're still depreciating the fixed assets, but we're getting more out of that idle space. So we also need to consider overall the effect is actually this number, $114,500. This is we're paying. This is also the cost that occurred, expenses for machinery. But this is what we're getting. After outsourcing the free space, we're able to get this profit. So before this actually happens, our analysis at the end, the overall cost really is just this. $40,000 was the fixed overhead, assumed from the problem then. If we do have machinery still used to package whatever the outsourced products with others, so if we still need to depreciate that machine, it's still considered a fixed cost that occurred. Its unavoidable portion is $40,000. We'll be outsourcing it because it's cheaper, because considering the idle machinery, idle space, yes, the final answer would be, since this is lower than manufacturing in-house, then we'll be outsourcing it. Okay, so the decision-making process here is what's the money that we're paying others, mainly is this, and then plus anything that we're getting out from the idle space. Of course, if we're just determining to minimize the manufacturing plan, then there wouldn't be this place. But if that's not the case, usually the free space will be able to support other production cycles products. If we're getting profit out of it, subtract it. So the overall cost really is $114,500 instead of the original, considering the profit we're getting. Okay, is this better? All right, let's take a look at other factors. Perhaps managers may also want to consider whether the outsourcing product they're able to get from the supplier and vendor is at a quality that they're able to accept. So basically they need to choose wisely from the different vendors and suppliers. They need to do some research beforehand. So some of the qualitative factors that may affect their decision, if they can't find a reliable supplier and vendor, meaning whatever the sample products they had from those vendors, those suppliers, they don't think it's meeting the quality standards in their company, they may decide to still produce it in-house even though it costs a little bit more. So some of the qualitative factors that could, quality factors, controlling factors, because if they outsource it, that means whatever that comes in, it's to an extent completed, right? Perhaps you want to either assemble together with other products, or perhaps it's actually a completed product itself. So if you're selling it with your company's brand, then customers will think this is your company's products. They want to keep control of their different products' quality. So in summary, basically, if they're able to find a reliable supplier vendor at a reasonable cost, based on the analysis we did earlier, considering also free capacity, the cost of purchasing it, altogether they will decide on the ones with the lowest number. Okay, so they can actually focus more on whatever they're good at producing. So focus more on their core competencies. Okay, so main decision rule here. Just like special order, we need to consider the increased revenue against the increased cost. Dropping products, we need to know contribution margin, cost saving compared against revenue. So the main decision rule here is whether the incremental cost of, basically the cost of producing the product, how is it, to what extent is it lower or higher than outsourcing? And what we mean by outsourcing is not just the purchase price, it's also whatever cost saving we're able to make from the idle space combined. Now, whether to continue processing a product, continue manufacturing a product, or sell it as it is, you can probably guess by now. Since we're all doing cost and revenue analysis, this follows the same logic. So, do we want to sell the product right now as it is, simply a gallon of milk? Or do we want to process further into cheese, into other dairy products, half and half? Depends on, of course, we're assuming customers has the needs for those type of products, and then we do analysis on what's the cost you need to spend to process it further compared against the revenue that you're getting out of processing further, having a process further product. Okay, so how much revenue will the company receive if the company sells the products right now as it is, just simply a gallon of milk? Or do they want to continue to process it into different types of dairy products like cheese, pasteurized milk, sour cream? Do their products has demand in the market? And is it worth it to process it further? In the middle, what's the manufacturing cost that will incur? Are there other tools that we need to purchase to produce this? Or do we have to hire other people? That cost compared against what is the increased revenue for processing further that product and the original gallon of milk, for example. Okay, so what's the processing cost that we need to incur, and what is the increased revenue? So it's actually very similar to accepting the special order or not. What is the increased revenue we're getting, and what is the excessive cost we're spending? These two compared, which one is higher, which one is lower. So here for selling as it is right now and process it further, same thing. We want to compare whether increased cost is worth it or not. Are we actually getting more revenue after spending that cost to process it further? So let's take a look at this example here. Let's say this is a natural resources company on oil and gas. You readily did research, development, and spent $125,000. This is a sunk cost. So remember what sunk cost is? Any money that you readily spent, right? It's already being purchased. It's already being received. Well, basically, cost means any money that you readily spent before. It's in the system. So that $125,000 is occurred in the past, meaning you're not changing anything. Determining selling as it is or process it further, you're not changing that cost, okay? So think of that as developing the plant, whatever the money you spent there. So you use that sunk cost and you produce 50,000 gallons of regular gasoline. And now you have two alternatives here. You can either sell it as it is right now as regular gasoline, assuming they did analysis and they project that the revenue is $190,000. You have another option, spend more money on processing further, some of the tools or other techniques, and you spend $7,500. This cost to process it further into premium gasoline. And you project that you're getting sales revenue $200,000 out of that. So these two ways, if you were the manager, which one would you suggest? Processing further, because $7,500 you're spending, but you're getting more out of that, $200,000. And $200,000 compared against $190,000, the difference was $10,000. So you have increased revenue $10,000 there, and your cost really is just additional $7,500. Okay, so for selling as it is, the original sales revenue was $190,000. You process it further, you had additional cost, of course, but the increased revenue, the revenue difference is higher than the cost. So the revenue boosted up to $10,000 more, your cost is only $700. Difference is you have a positive profit there after choosing the second option. Okay, so of course, again, this has to be matched against what's the market's demand right now, and whether two types of product customers are able to accept. If you're processing further on something that nobody's interested in, then of course that's not the way to go, even though perhaps the projected revenue is higher, but that's assuming that customer is purchasing them all. That's the retail price you're getting. But what if there's no demand there, then you will not be able to sell it at that price. Okay, so here the grounding is we're assuming that the products, the decisions they made already is they know where's customer's preference, and they just need to decide the cost and revenue, weigh which one is more beneficial for their company. Okay, so the main decision rule here, calculate what is the extra revenue against the extra cost, which one is higher than the other. If we have extra revenue, of course, we want to process it further. If not, then simply sell it as it is right now. So the cost you need to spend on processing further, you need to get a lot more machinery, a lot more different tools, equipments. There's too much investment cost there, and it actually exceeds the revenue, the excessive revenue you're getting after processing it. And of course, you just sell it as it is actually better. Okay, exercise time. Let's work on this problem, whether to outsource, purchase bread for another bakery, or actually to bake it themselves in-house. So I highlighted some of the numbers that you will need, especially for this problem. Variable cost, of ingredients, variable costs on overhead, electricity of the oven, labor cost. Those are the costs that will incur if you produce it in-house. Okay, now, also labor costs, 96 cents for the fixed overhead per loaf. Now, if you purchase it elsewhere, other bakery, you're spending each loaf $1.75. And this problem tells you that none of the fixed costs are avoidable. Okay, so try to calculate both sides of the costs and then compare them and try to determine whether you want to produce it in-house or buy it elsewhere. So notice that this problem is less complicated, so it doesn't tell you any free capacity issues. So you can just assume you don't have to consider any idle facilities. Yeah, sure. You want to try? $2.40. Mm-hmm. Okay. Fixed overhead, yes. Okay. Okay, good. So the $1.46 is the variable cost altogether, right? Then you add fixed cost, 0.96, and then you get the total unit cost for every loaf of bread is $2.42. So this is the manufacturing in-house part. What about outsourcing? So you're getting $1.75 and also fixed cost, right? Because fixed cost is, none of the fixed costs are avoidable, so meaning that this 96 cents altogether, if we add it in, it would be $2.71. So if we just compare these two numbers, it's pretty obvious that we should be actually producing it by themselves, in-house, right? So unit cost, yes, thank you. It's $2.42 for each and every loaf of bread. If these are avoidable, yes. If avoidable, then it will be $1.75 compared against $2.42. Then we will directly buy it because it's cheaper. Yes. So producing in-house is $2.42. Adding different categories of variable cost plus at the end 96 cents. So together each loaf of bread is $2.42. Outsourcing costs, we need to spend $1.75 to purchase each loaf. We also have fixed costs to maintain it, and the quality of the bread, 96 cents for each loaf. So another way to think about this is that you can just drop fixed costs altogether. Just compare $1.75 against $1.46. Just the variable costs with the purchase costs, because fixed costs are there either way. Okay, so either way you can add them up together or just compare variable costs with the purchase cost to give you the same answer. You should produce it in-house because it's cheaper. So what else do you think they may want to consider before making this decision? So this is the numbers part. The 29 cents? Oh, okay. Well, opportunity cost, probably that would be if, in the case that they had a specific oven just for this loaf of bread, and you can use that oven for something else, then that will be considered like the opportunity cost, which we don't have enough information right now, right? So you may be able to use that idle either baking time to do something else, or actually ask whoever was in charge for baking that, the laborers, to do something else. And if there is profit out of that, that will have to reduce it from the outsourcing cost. Yes. Other things, for example, remember the idea of just in time? What if they're not able to get some of the products on time? So timing issues, especially for food business, sometimes this is also a critical point. So bakeries, some people may just aim at certain timing when they know all the fresh breads are coming out. They want to visit the bakery to get the fresh ones. Timing and the quality of the bread. Remember, quality works for all cases. Okay, whether to outsource or not, they need to make sure that the products are meeting the quality demands. Okay, because anyhow they're selling it at their own bakery, so it seems like their product. You need to make sure that it has to be controlled to a certain point. Okay, so this week for next homework you will have questions on pretty much all of these decisions. Just kind of go back to look at the general idea again is the same. Cost-benefit analysis, whether we're spending excessive money and what is the output out of this, what's the revenue we're gaining. Some of them are a little different. For example, pricing decisions, the bottom-up approach or top-to-bottom is a little different for different industries. Whether or not to drop a product, don't forget that fixed costs sometimes will make a difference in some of the decisions. If there's avoidable portion or unavoidable portion. Okay, let's just work on a few exercise problems for this chapter at the end. So some of them I think we went over already. Just choose some of the ones that you all didn't answer immediately last time. So making short-term decisions, which ones seem pretty critical here? Variable cost and fixed costs, we definitely need to separate them. So remember, for outsourcing, for dropping a product, those will make a difference. So having a contribution margin is not enough. We also need to analyze whether there is avoidable fixed cost or unavoidable part. But definitely we need to separate them first. Okay, now when making outsourcing decisions, which one seems important here? What is relevant? Well, B, seems like a majority agrees on B, right? Variable cost of producing the product in-house is relevant. That's relevant. So what's the problem with A? It's relevant, free capacity. It's usable sometimes for other products. Avoidable fixed costs are irrelevant. You also consider avoidable fixed costs. Remember the example we went over with the 50,000 and 40,000. So we avoided 10,000 fixed costs. So that's also important. What about D? What's wrong with D? Well, D, the part that may seem a little, we seem with error is the unit cost part. Okay, incremental cost, remember for all of these, we're looking at incremental cost, incremental revenue, and we're comparing whether incremental cost is more or less than incremental revenue. But total manufacturing unit cost, in terms of making outsourcing decisions, the unit cost wouldn't really matter that much. Well, the total production cost does, and we want to compare that against the incremental cost, which is the outsourcing cost, and the free capacity if we can get any profit out of it. Most importantly, what the decision rule that links to the outsourcing decision is the weighing those two differences rather than understanding the total manufacturing cost and each unit cost. Okay, so incremental costs is important, and it's important to compare themselves. Okay, deciding which product lines to emphasize, what is the decision rule here? What to emphasize? A is good, but not good enough. Contribution margin per unit of product is important, which one is high, but it's also important, remember, for each and every hour, how many products we're actually able to produce to provide customers. So we need to figure out, again, that DVD example, regulars and special ones, which one we can produce more in quantity, and then we time the unit contribution margin. Remember that example with 100 regular discs, 10 special discs, each of them getting 90 cents, 10 cents, but overall you're getting $10 here and $9 for the other. So you want to get the one with the highest contribution margin per unit, assuming this is every single hour's production. Okay, so this would be B. Same also works for labor hours. This is just one example, machine hours. Like labor hours, machine hours, you want to know for all the working hours how much you're able to actually get out of them, assuming all of them will be sold out to customer. Okay. Okay, for price setters companies, their products and services, price setters, to be unique, has special features. Remember, they have more control on setting the products price, so it's technology-driven products, jewelries, art businesses. So more unique, has more cutting advantage over their competitors. Okay, now whether or not to drop an electronic product line, kitchenware.com would consider what? All of the above. So I think we went over this question, right? Cost it would save by dropping. Revenue it will lose if they drop the products. So remember, compare cost saving against revenues. And how dropping a product would affect other sales products. This sometimes they also need to consider, especially for departmental stores when you're offering a lot different types of products in your store. You may want to consider whether customers would not want to come because of this specific decision. Okay, decide whether to sell as is, process further. What do you need to ignore? Not consider, nor ignore. A, B. The cost of processing further, B, is definitely something we need to consider. Remember the gasoline example, $7,500, the cost, any machines, techniques you're purchasing and to help you process. So this one would be A, because whatever the cost you used thus far, remember that's sunk cost. It's not really relevant to this decision. Revenue you're getting from selling it as it is right now, you need that to compare it against revenue that you're getting after processing further. And so whichever one is higher, and also the difference is, does it cover the cost of processing further? Does it cover the cost of purchasing more machine, hiring more people? That's important. So if it doesn't cover it, then we still sell it as it is right now. If it does, it's an option. You can move forward, process it further.